Thank you very much. Good afternoon, everybody. I hope you're all still awake. Let me just wait for my... brilliant. Next slide, please. Okay, good. So what I'm going to be talking to you about in half an hour is just financial literacy and how to manage money. Manage money and also how to make money grow, basically. So that's what we're going to be talking about, financial literacy, valuing money, and the financial markets in general. Next slide. Now, this is a very good quote from Robert Kiyosaki. It says, it's not how much you make, but how much you keep. How hard it works for you, and how many generations you keep it for. So really, that quote more or less summarizes what financial literacy is all about. It's how do you manage money? When money comes your way, do you keep it? And when you keep it, do you make it grow? And when it grows for you, is it enough for the future generations? And that's what we're going to be talking about. Next slide. So financial literacy is a knowledge and capability in personal money management. Next. And the key here is the ability to make informed judgments, and that's the key word there. What is your ability to make informed judgments? So what informs your decisions when it comes to money, and also take effective decisions regarding the use and management of money? How are you going to manage $1 million? What are you going to buy with it? What are you going to invest it in? And if you can't answer those questions quickly, then it means you haven't planned for how you're going to use money and how you're going to take effective decisions regarding it. And also, the other thing some people say is, okay, if you give me $1 million, I'll buy property. Then the question is, what is informing your decision regarding real estate? Do you have enough information and knowledge about real estate? Or some people will say, okay, I want to buy stocks and shares. But do you have enough information? What is informing your decision on stocks and shares? So whatever decision you're trying to make regarding money, how much information do you have about what you want to do and what is informing that decision? And that's the key to financial literacy. The other thing about financial literacy, or the book definition of financial literacy, is how well do you understand certain financial terms? Because for you to be classified as what we call being financially literate, it means you understand what consumer price index is. It means you understand what interest rates are. It means you understand the importance of savings. It means you understand investing. Now, if you understand all these things, then you're classed as being financially literate. If you don't understand them, then you're classed as financially illiterate. Next slide. And you can see from this article from 2015, it showed that 43% of Americans and 2/3, that's a big number, 2/3 of the world's population are financially illiterate. So 2/3 of adults all around the world are classified as financially illiterate, meaning they don't know how this money thing works. And as we all know, it's very important to understand how money works. Next slide. So the first thing we'll talk about is consumer price index. Consumer price index is also known as inflation. That's another term for consumer price index. And I'll take some time to explain this carefully, because it's crucial that you understand what consumer price index means, and most importantly, how it applies to you. Oh, before you self-define consumer price index, how many of you understand consumer price index? Or who can define it? Okay, so I'm going to take my time and define it, because this is very, very important. Now, consumer price index is a measure. I'm going to say this very slowly. Consumer price index is a measure of the rate of increase of basic goods and services. Okay, I'll say that again. Consumer price index is a measure of the rate of increase of basic consumer goods and services. So basically what every country does is that they will measure how much the prices of what you use on a daily basis, how much is going up by every year. So they do it over the course of a year. So for example, we're currently in the month of April. So what they will do is that in this month of April, they will see how much prices of basic goods and services has gone up from April last year till April this year, and the report will come out in May. Are you all following? Then they'll do the same in May. They will find out how much all these things have gone up in price from May last year to May this year. The report will come out in June. So the report comes out every month, but they're measuring it over a year. And the key is to understand what they're measuring. They're measuring how much the cost of simple things you use. So if you use yourself as an example, they want to find out what is the, let's say you're waking up in a house. What are the average cost of clothes, average cost of beddings or mattress, average cost of rent, average cost of gari, milk, sugar, basic things you use, average cost of toothpaste, toothbrush, if you're going out, average cost of petrol, average cost of transport fare. All these things that they measure are the things that everybody uses on a daily basis. Are you all following? So they're looking at how much all these things you use on a daily basis has gone up in value over the year. So what that means in essence is that if the cost of living or the cost of these things you use on a daily basis, if they've gone up by 5% in 1 year, for you to maintain that same standard of living, how much your salary go up by? The same thing, the same 5%. So if the cost of living has gone up by 5%, your salary too needs to go up by 5% for you to maintain just that basic lifestyle. Okay, if the cost of living is going up by 5% and your salary doesn't go up at the same level, what happens? Yeah, so that means your spending power is less. So, and if that keeps happening every year till you retire, what's going to happen to you? You're going to be in trouble. So you can see that's why the consumer price index is very important, because you now begin to see that inflation has a real impact on you on a daily basis. Because if the cost of living is going up and your salary is not going up with inflation, then you're going backwards. And it applies not only to your salary. If you're running a business and the cost of inflation is 5% and the profit you're returning every year in your business is 2%, then you're not making money. So regardless of what you're doing, if you have an investment and your investment and inflation is 5% and your investment is returning 2%, then you're not making money. So you can see that for you to classify yourself as making money, you want to make above inflation. Isn't that right? So your investment, your business, your salary, whatever it is, needs to be above inflation for you to be able to cope. Now, next, let's just see what the inflation for Nigeria is. Next slide. Let's keep going till we get to Nigeria. Quickly. Next, all the way down to the last one. So you can see Nigeria now is 11.25. Keep going. Yeah, so Nigeria now, that's inflation for Nigeria is 11.25% a year. So cost of living in Nigeria is going up by 11.25%. So the question you have to ask yourself is that, is your salary going up by 11.25%? No. If you have a savings account, do you have an interest rate of 11.25% on your savings account? No. So you're in trouble, isn't that right? There's wahala. So we have to solve this problem. So you can see that's why this is a very important thing to understand. Because that is why you run out of money before the end of the month. Because your spending power is not keeping at pace with inflation. So that's why you tend to run out of money. You get your salary, they give you a salary increase, you get a bonus, but somehow there's just not enough money. And this is the reason why. Because it is not keeping at pace with inflation. And this is the official inflation. There's what we call the Indomie Index. Have you heard of the Indomie Index? Now, the Indomie Index also shows you the reality of inflation. How much do you think the price of Indomie has gone up from last year to this year? It's gone up by over 100%. So you can show that even inflation is much higher than 11.25%. But we'll go with the official figure, which is 11.25%. So at least you want to see that you want to beat at least 11.25% for you to at least have a basic lifestyle. And I'm sure everybody here wants to have above basic lifestyle. So basically you want to get a return way higher than 11.25%. Okay? So at least now you now know that once you understand consumer price index, you now know what your target is. So your target for your salary increase is to get something that is better than 11.25% a year. So if you cannot convince your boss to give you a salary raise of 12, 13, 15% a year, what other option do you have? Is to find an investment or a business that will give you a return at least at the same as inflation, or if not higher. So that's what your goal and target is that you want to find something that will give you good return on your money. And like Mrs. Tokumbo Ishmael said in the morning, when she was talking about multiple streams of income and investment, we're now coming to that now. So any income stream you're trying to start, any business you're trying to start, any investment you're trying to do, this is what you're targeting. You want return that is at the same level as inflation, but obviously preferably much higher. Next slide. Next slide. Okay, so this is a question for you. Which do you prefer? Do you want me to give you, next slide, 1,000 naira every day for 30 days, or next one, teach you to double 1 kobo every day for 30 days? Which do you prefer? Teach. So what's 1,000 naira every day for 30 days? And then if you double 1 kobo every day for 30 days, how much is that? Sorry? 15,000. Okay. Next slide. So 1,000 naira a day for 30 days is 30,000. Next one. 1 kobo doubled every day for 30 days, 2.6 million naira. Okay, that's a good question. What concept is that? Who can guess? How did that make that possible? Sorry? Compound interest. That is the magic of compound interest. That's another thing you need to understand in terms of financial literacy. How, if you can earn compound interest, it will make a small amount of money become a lot in a short time. And that's the magic of compound interest. So basically, if you go home, you can do the calculation at home. On day 1 is 2 kobo. Day 2 is 4, 8, 16, 32. So you're just doubling every day for 30 days, you get to 2.6 million naira. So it shows you that even with small money, used properly or invested in something good and you gain compound interest, you can get a lot of money. Next slide. So this is just a quote from Albert Einstein. He said the greatest mathematical invention known to man is compound interest. Next slide. So prosperous people earn compound interest. So what prosperous people do is just like what Dr. Ishmael said this morning, is you try and reduce your expenses, you try and save money, But once you've saved it, you then try and earn compound interest on the money you've saved so that it can multiply. Next slide. Whereas poor people pay compound interest, and the way you pay compound interest is through debt and loans, because you are now the one paying the bank compound interest on debt and loans. Next slide. The next one. So this is just a chart showing you the magic of compound interest. The blue section shows you if you just had $1,000 but at no interest, like, the same $1,000 with the same after 20 years. Now the one in red is what you call simple interest. So if you maybe got 10% simple interest on 1,000 naira over 20 years, but without it being compounded, you get some money, but you can see it's not a lot. Whereas with compound interest, you can see the exponential change in the returns of your money. So what you want to do is try and find investments where you can get compound interest. Next slide. Next one. One more. Okay, so this is just showing you the value of money. How by you just saving 360 naira a day, you can turn it into 360 million naira. So just by saving 360 naira a day, or about 7,500 naira a month, invested wisely, that can become 360 million naira. And the way that happens, it depends on what returns you're getting on your money every year. So if you look at the table, these interest rates are showing you annual returns. Annual return. So if you're saving 7,000 naira every month and you're getting a 3% return every year on your 7,500 every month, you will get 360 million naira in 150 years, which is what you probably get in your savings account when you have 2% or in your savings account. Now, let's just jump to 10%, because you can easily get 10% in Nigeria. And I'll show you how you can easily get 10% today in Nigeria easily. So with 10%, doing 7,500 naira every month, you're saving 7,500 naira every single month. You invest it in something that is giving you 10% a year, compounded. You get 360 million naira in 59 years. So the question is, how do you shorten the duration? Any guesses? Sorry? You increase the savings. So you see, it's not rocket science. It's not rocket science. So if you want to shorten that duration of 59 years, you invest more money. Where will that more money come from? Where's the microphone? Where will the more money come from? Sorry? We want a simple, not reinvestment, but a practical place where that more money will come from.
We invest in the capital and the profit.
No. Yes? At the back. Where will that more money come from?
I think from your savings, you discipline yourself
exactly
to save more.
It's from reducing your expenses. Because you'll be surprised how much money you can make from what you're earning now. And I'm happy Mrs. Ishmael discussed that this morning. So it's by cutting your expenses. Something has to give. You now have to prioritize. So when you get 1 naira, you have to decide, where do I put this 1 naira that is of priority to me? You have to ask yourself, do I need that new suit? That new shoe? Do I have to go to Chicken Republic? You have to make these decisions because the money has to come from somewhere. So the best place is by cutting your expenses. It can come from what you're already earning. And of course, you can, again, like she said, and like Tonya Cole said, you can also get more money from extra sources of income by increasing your side hustle or trying to make some more money or getting an extra business to get more money in. Of course, you can do both. You can cut your expenses and also increase your income. And then that's where you can get more money to get to your goal quicker. So you can see most of these things are very practical. It's all logic. 7,500 a month, every month, getting 10% return on your money every year. You will get 360 million in 59 years. And like I said, if you want to reduce that duration, you just invest more. And to get more money to invest, you know what to do. Okay, next slide. Right. So, like we've said earlier, the bottom line and the aim is that you just want to beat consumer price index. You want the return on your money, the return on your investment, the return on your business to be more than inflation. That's the bottom line. Now, you can do this in so many different ways. So like I said, it's all about multiple streams of incomes. But whatever business you're opening or whatever business you're starting, you want to make sure that the returns or the profit you're getting is more than inflation. So it's all about multiple streams of income. But one way you can do that, which is what I'll be talking about, one way, one of many ways, but one way you can do it is to invest in the financial markets. So by investing in the financial markets is one way you can start to get good returns on your money and also compound interest. So to quickly tell you about the financial markets, there are 4 components of the financial markets. Keep going. Okay, so these are the 4 major components of the financial markets. So when you hear the word financial markets, it means these 4 parts. It has 4 parts. The fixed income securities market, where you get the bonds and treasury bills. The stock market, where you're invested in company stocks and shares. The currency or the forex market, or the commodities market, where you can invest in oil, gold, coffee, wheat, and all that. So those are the 4 major components of the financial markets. They're all separate. The fixed income securities market is different from the stock market. Stock market is different from the currency market. Currency market is different from the commodities market. That's the first thing to understand about the financial markets, is that there are 4 separate parts. Next slide. So the next thing you need to now understand also is what we call investment risk. And a simple way to understand investment risk just means what are your chances of losing money? Not making money. What are your chances of losing money? Okay, next slide. So if you look at low risk means you have a low chance of losing money. Are you all clear? So when you see the term low risk, it means you have a low chance of losing money. So if you're the sort of person that if you lose 1 naira, you will kill yourself, then you have a low risk appetite. If you cannot afford to take any risk or lose any money, then you have low risk appetite. So low risk means low chance of losing money. And the only part of the financial markets that gives you low risk is the fixed income securities market. So if you're the sort of person that you're scared of taking risks, then I'll just advise you to stick to the fixed income securities market and buy bonds and treasury bills. And you can see in Nigeria, you can get up to 15% in the fixed income securities market. Next slide. So medium risk means medium chance of losing money. Medium chance of losing money. So if you're a sort of person that, okay, I don't mind taking some risk, but not too much, just a bit of risk, I don't mind losing some money, then long-term investment in the stock market is the best way to go. And the key word there is long-term investing, which means 5 years or more. And you can see 2 years ago, the stock market returned 41% in a year. Next slide. Then high risk means exactly what it means. High risk means what? High chance of losing money. So if you don't have a high risk appetite, if you're not ready to lose all your money, don't go there. High risk means high chance of losing money. And if you have a high risk appetite like myself, the best thing to do is then trade the forex market or the commodities market. Those are the best markets to trade, the commodities and the currency market, where you can get 100% return a year. So I think what I'm just trying to show you is that you have to manage your expectations. Because I know what everybody wants is 100% return with low risk. Isn't that right? It doesn't exist. That's 419. It does not exist. So if you're looking for 100% return and it's low risk, it does not exist. So you have to, that's the first question you have to ask yourself, what is your risk appetite? So you can see that obviously the higher the risk, the higher the returns. But you have to be sincere and clear with yourself. Know what your risk appetite is. If you have a low risk appetite, just go and buy bonds and treasury bills. If you don't mind taking some risk, then it's long-term investment in the stock market. And then if you have a high risk appetite, you can trade the currency or the commodities market. Next slide. So, I'll talk quickly to you about mutual funds. One way you can start investing, especially today, is by investing in what we call mutual funds. Mutual funds, it's just a way of helping you get into the financial markets very quickly. I was going to say there are two main ways you can get into the financial markets. One way is you can do it yourself. So you can start to look at stocks and shares in the market. You can say, okay, you want to buy GTB shares, Zenith Bank, Dangote, but you have to ask yourself the question, do you know how to assess stocks and shares? Do you know how to read the financials of the company you want to buy? Do you know how to do the analysis of this stock and know when to buy it and when not to buy it? So if you have that knowledge, which can easily be taught, if you have the knowledge of how to analyze stocks, analyze the financials of companies, and know when to buy and sell, you can buy these stocks and shares yourself and start that way. Now, if you don't have the time or the knowledge to do that, you can give your money to what we call a fund manager who can make that decision on your behalf. So basically what the fund manager will do is that maybe from all of you in the room, they can take money from all of you and they will make that decision of what to buy and sell, what stocks to buy, what investments to buy, and they make it on your behalf. And then the returns they get, they'll share it amongst all of you. Of course, if they lose, you also all share in the losses, but you pay the fund manager a fee for doing that service for you. And that's basically what a mutual fund is. So it's like I can see from the diagram, it's just a pool of money that goes to the fund manager to invest in the financial market, and it can generate returns that is passed back onto the investors. Next slide. So the one I can confidently advise all of you to start with, if you're new to investing, is to start with what we call the money market mutual fund. The money market mutual fund in Nigeria is a fund that specifically just invests in the fixed income securities market. So what this money market mutual fund does is that they invest in commercial paper, treasury bills, and bonds. So the risk is almost zero. So you have an almost zero risk investing in the money market mutual fund. And it's registered by the Securities Exchange Commission. Next slide. Next slide. And you can see the average annual returns on this fund is about 2 to 13% a year. So like I was saying before, you can easily get returns of 10%, and you can see it's even better than inflation. Inflation is 11.25%, and with this money market mutual fund, you can get returns of 12.7 to 13.62% annually. And the other beauty about this money market mutual fund is that the interest is compounded. So when you open an account with your stockbroker, obviously you have to ask them if they have a money market mutual fund. And if they do, and you start to invest in it, you can tell them to compound the interest. So you can start getting that kind of high return straight away. The risk is almost zero, and you can benefit from compound interest. So I think that's really specific advice I'll give you as to what to invest your money in today, because anything other than that might require more information and more teaching on what to do. But with this one is a no-brainer because the risk is so low, almost zero. You're investing in something that is very safe. You get your return of about 12.7 to 13.62% annually, and it's also compounded. Next slide. Oh, and by the way, most brokerage firms, the minimum to do this is 5,000 naira. And that's another good thing about the money market mutual fund, because you can start with as little as 5,000 naira and just be doing that on a monthly basis. But like we said earlier, if you want to get to your 360 million quicker, you have to do much more than 5,000 a month. But the beauty about this is that you can start from as little as 5,000 naira a month. In fact, you can open it with 5,000 naira, but you don't have to keep putting 5,000. You can start with 5,000 and maybe not put money there again for 3 or 4 months. Okay, so that's the good thing about this money market mutual fund. Next slide. Okay, oh, that's just the book I wrote on the financial markets, Trading and Investing Made Easy, if you want to get that. And we'll end on this note. So you can, that website, if you want some more information on financial literacy and information about understanding the financial markets, you can go to our website. And of course, you can contact us on social media too.